For decades, home ownership was the foundation of generational wealth, until Wall Street transformed residential housing into an institutional asset class, controlled by a single algorithm. In this explainer, we're diving deep into a structural economic phenomenon, the silent landlord. We'll explore exactly how this corporate invasion connects directly to the systemic housing shortages and affordability crises reshaping major Western markets right now. There are no assumptions here, just the macroeconomic data.
Historically, the American housing market was a highly decentralized ecosystem. It was built by local actors and driven by local dynamics. Think individual homeowners and neighborhood landlords operating in a heavily localized system. But that ecosystem has fundamentally changed. It's been steadily absorbed in the global financial flows, effectively replacing neighborhood negotiation with highly structured capital extraction.
So how do we get here? Let's trace the evolution of housing financialization. This certainly didn't happen overnight. If you lived through the 2008 financial crisis, you witnessed the catalyst for financialization 1.0. Following the crash, private equity and hedge funds seized an unprecedented opportunity to buy distressed homes for pennies on the dollar. Moving into the 2010s, we hit financialization 2.0. Real estate investment trusts, or REITs, and massive pension funds entered the space, prioritizing long-term income streams and standardizing the single-family home as a tradable asset class. And today, we are deep into financialization 3.0. This is an era defined by aggressive expansion into specialized niche markets and the deployment of highly sophisticated algorithmic pricing.
But what does this algorithmic shift actually look like on the ground? Well, for millions of low-income tenants, the rent-to-income burden has surged way past the historical breaking point of 30% and is now eclipsing 50%. When a handful of large landlords control the entry and exit points to tens of thousands of local rental units, it creates an intense, highly localized fear of corporate displacement and systemic, inescapable rent hikes.
But here is where the local narrative collides with mathematical reality. Despite this profound fear of corporate displacement, the single-family rental market in the United States remains extraordinarily fragmented. Out of a national stock of 82 million single-family homes, institutional investors, which we're defining here as those owning 1,000 or more homes, own approximately 450,000. That represents a statistically insignificant 0.55% of the national supply. A market participant holding roughly 0.5% of the total supply simply lacks the macroeconomic power to unilaterally dictate terms to the other 99%.
And this brilliantly illustrates where the narrative and the data intersect. While the national ownership average is just a fraction of a percent, corporate capital doesn't buy randomly. It buys tactically. Institutional investors are aggressively concentrating their acquisitions in very specific, high-growth Sunbelt markets to build regional density. When analyzing the hyperlocal data between 2018 and 2024, you'll see massive jumps in targeted cities like Dallas, where institutional holdings nearly doubled, and Phoenix, which rapidly crossed 32,000 institutionally owned homes. The power isn't national, it's hyper-regional.
This brings us to the algorithmic pricing matrix. How exactly do landlords maximize yield in these deeply concentrated markets? According to allegations in an ongoing antitrust lawsuit led by the Justice Department and multiple state attorneys general, the answer is yield management software. The DOJ claims this matrix works in 3 steps. Step 1, competing landlords allegedly share competitively sensitive, non-public data with a third party. Step 2, a pricing algorithm, specifically from a company called RealPage, processes this aggregated data. And Step 3, the software generates market-wide rent price recommendations. The government claims this artificially aligns prices across competing properties, essentially bypassing normal market competition.
The legal fallout from these allegations has been massive, yet deeply contested. The DOJ and 9 state attorneys general have actively pursued major corporate landlords. We've seen several settlements reached. LivCor and Greystar each settled for $7 million, and Cortland settled recently as well. However, it's absolutely paramount to note that firms like LivCor have explicitly denied all fault, liability, and wrongdoing. These corporate landlords maintain that they set their prices independently, arguing that the software simply aids efficiency in complex, rapidly shifting markets. Meanwhile, the litigation against RealPage itself alongside managers, like Willowbridge, remains ongoing as the courts weigh the fine boundaries between technological efficiency and algorithmic price fixing.
Now, let's transition to the ultimate macroeconomic reality, the shift to wealth-driven housing. We are witnessing a systematic change from a debt-driven housing model to a wealth-driven one. In the past, the expansion of mortgage credit allowed the working middle class to literally buy a stake in their neighborhood. Today, that mechanism is being re-engineered. Housing is fundamentally transitioning from a vehicle for middle-class wealth creation into a yield-generating engine for those who already hold massive capital.
Why does this transition matter? Because the stakes are permanently life-altering. Homeownership is the primary wealth-building mechanism for middle-class Americans. It's not standard investments, and it's not wages. When an institutional investor removes a home from the owner-occupied market, that future appreciation is captured by a corporation rather than a family. To put that into perspective, the wealth difference between a lifetime renter and a homeowner can reach up to $1.37 million. That is a massive generational gap that compounds over time. Families that cannot own cannot pass wealth to their children, creating a permanently bifurcated society.
But as investigative macroeconomists, we have to look at the entire board. Counter data from the Progressive Policy Institute reveals a highly complex picture. Markets with low institutional ownership like Knoxville and Miami have actually seen massive home price appreciation. Conversely, highly institutionalized markets like Atlanta have seen comparatively lower appreciation. The data insists that high institutional ownership doesn't inherently or exclusively drive up home prices. The overarching issue remains a fundamental lack of overall housing supply.
So, we have to synthesize this central economic contradiction. On one hand, we have the feudal estate effect. Structural models show that for every property purchased by an institutional investor, the number of houses belonging to normal homeowners falls by 0.22. It permanently removes some entry-level homes from potential buyers, concentrating wealth upward. On the other hand, we have capital efficiency. Institutional investors deploy massive capital to rehabilitate aging properties, spending an average of $39,000 on upfront rehabs compared to a normal homeowner's $6,300. Plus, they're actually expanding the total rental supply through massive new build-to-rent developments that just wouldn't exist otherwise. It presents a brutal paradox. They act as a barrier to traditional ownership while simultaneously acting as a vital supplier of high-quality newly built rentals. Which brings us to the precipice of our analysis. The silent landlord isn't a simple villain, nor are they a benevolent provider. They are the apex predators of a mathematically perfect, yet socially volatile market. If housing is simultaneously a fundamental human necessity and a hyper-efficient financial asset, can a society survive when it must choose between the two? We have to weigh the ultimate macroeconomic reality. Are we headed toward a future split cleanly between corporate capital providers and a permanent renting class? Analyze the data, watch the algorithms, and consider who truly owns your neighborhood.